since the bad debt happens, so now my job is to estimate the provision for doubtful debt. Provision for doubtful debt means that the PDD, since I have bad debts happen, I want to be prudent. I don't want suddenly the bad debts happen, then only I declare. Then my profit for the year compared to the last year will suddenly dramatically drop due to the bad debts happen. So to be prudent every year, I prepare a little bit of the estimation of the bad debts. So then my profit for the year won't be dramatically drop in the profit for the year, and it will be constantly reduced a little bit. If there is a means that I estimated certain percentage of the possible bad debt happens, but it is not actually happen, it's possible. And then after that, how to know possible or not? They will have a credit control policy that see their trend of money received from their trade receivables. Okay, so from there they can see this is the chart and who are the higher chances that not paying me, because after 3 months they still haven't pay me, after 6 months very slow payment. Okay, so from this I can estimate roughly 2% to 3%. The first year creating when there is provision for doubtful debt happens, you need to declare in your IS as expenses, and also as well as minus under the trade receivable in their SOP. So you need to enter two sides: IS expenses, SOP, CA under trade receivable minus. Okay, so what if the following year, then you have to compare. Is that higher than last year estimation? If higher, the highest amount, the greatest amount, you will put into the IS as a expenses. If lowest amount, the lowest amount compared to last year, then you must put it as other income, because I thought that much of the estimated provision for doubtful debt, but somehow is lower, maybe due to the reducing of the credit sales. So reducing of the credit sale, it might cost you lesser chances of the bad debts. Okay, all right, so now we go to the details here. The PDD means estimated or anticipate amount will be losses because of the bad debt. Applying accounting rules of the prudence and matching. So prudent means that I cannot overstate the profit or asset of the year, and matching means that I must match the income against with the expenses within the same accounting period. So if there is something happen, losses, I must declare. So prudence, ensure the profit and asset do not overstate it, and matching, sales unlikely to be paid regarded as expenses. So formula to find the PDD for the year: method 1 and 2. Method 1 is directly use the trade receivable time PDD rate they will provide in your exam. Method 2 is trade receivable minus the bad debt time PDD. In when will using the method 1 or method 2? How do we know when is the time to use method 1 and method 2? You can see your trial balance. If you can check your trial balance, if the trade receivable show in your trial balance and also bad debt show under the trial balance, your trade receivable do not need to minus bad debt again. Why I say again? Because they already reflect in their trade receivable T account, means that they already minus before they get this trade receivable account, trade receivable amount, and stated in their trade receivable. They already closed with deducted the bad debts. What if the bad debts happens under the additional information right after the trial balance? This means that at the end of the financial year, then only they find out, I forgot to record the bad debts, so I didn't record the bad debts into my trade receivable. So you need to help them to adjust to the final amount. Therefore, you use the method 2, trade receivable minus bad debt times PPD rate. Okay, so in two situations of PPD, as I said, if new creating, then you need to enter into IS as expenses the whole amount, the same amount, and also as well as minus under the CA. And if there is a following year, you compare. If more than last year, you put it in expenses. the greater amount. So if decrease in the PDD compared to last year, it is under IS incomes section. So the under the SOIP will show the latest PDD calculated amount. Okay. When there is a newly created provision for doubtful debt, example 3. So trade receivable for the year 2023 is 10,000. PDD, let's say, is 2%. Find PDD for the year sorry, I think I forgot to type and enter the extract for SOIP purpose. Okay, PDD in ledger record and IS transfer when there is a new creating PDD for the year. Means that previously I never create the PDD and now only I started. So open a T account for the provision for doubtful debt. Credit is plus, debit is minus. Why do they put the plus under credit? Because later we're going to adjust. Can you see the last financial statement, the statement of financial position? They need to minus under the trade receivable. Therefore, the plus and minus side must be opposite with their trade receivable. Okay, long story short. And now, the provision for the doubtful debt when it's happened, I must add into the credit side. And the detail will show income statement. This is the amount that I'm going to transfer to income statement, 200. And then balance CD. Why do I need the balance CD? Because I need to compare next year. So balance CD is 200 and close the account with double line. Both sides also 200. Done. Always remember, balance CD in PDD will show under the SOIP. And the income statement amount move to the income statement. Remember, so the blue color income statement amount I credit here, I debit the income statement as a expenses. And the debit side balance CD, it will show under the current asset less. Okay. What if there is a following year? I think the title I need to change. It's not creating, it's the following year. So later I will change for you guys. So what if there's a following year preparation for the provision for doubtful debt? In this situation, your entry for provision for doubtful debt is slightly different. Okay, you will have the balance BD. Okay, exactly the same for question, but I changed a little bit. Trade receivable for the year 2024 is 20,000, and found there is a, can you see there's an increase to 20,000. You increase in the sales, then there might be the chances of increasing the PDD because you're going to use the TR time PDD rate. And the birthday will be 1,000 at the end of the day, 31 December 2024. There is a PDD 2%. Find the PDD for the year and extract for SOIP. So working, I need to do some working before I enter into the T account for the PDD account, financial statement for IS and SOIP. Okay, working number 2. TR minus the bad debt because the bad debt is the extra information after I close the TR account. So therefore I need to minus a second method. 20,000 minus 1,000 equals to and then time 2% equals to 380. Compared to last year, my PTD, can you look at the provision for doubtful debt account? Last year balance CD is 200. And this year I'm going to record 380 into my balance CD, into my SOIP. So compare 380 to 200 PTD last year. How much of increase? This increase by 180. So means that my losses increase now. I expected always 200. Suddenly this year because of the credit sales increase. Therefore, common sense what? My credit sales increase, of course my chances of bad debt will be increased. And then my income statement must declare this increased amount 180 as a losses. What if there is decrease? Then I will declare as the other income after the gross profit. Okay, come back to this question. And then my balance BD will be credit side in my PDD account. And the current year's total PDD will be 300. I put it under balance CD debit side. So the different 380 minus 200 will be my 180 balancing amount in the income statement. So 380 and 380 balance, and I move the 180 to the expenses IS. And then after that, the balance CD that I see that show in the PDD, I move to my statement of financial position, let the trade receivable minus. Okay. Thank you very much, and the details I will explain in the class later.